Since he gave the world Facebook back in 2004, Mark Zuckerberg has burned $92.4 billion on the only other big idea that was ever his own.
That's too bad. I don't know what happened.
6 years of reality labs and a virtual world so thinly attended that one of his own executives had to send an internal memo asking staff why they didn't want to use the thing they'd spent a fortune building. Meanwhile, Instagram cost Zuckerberg about $1 billion, WhatsApp cost him $19 billion, and Oculus cost him $2 billion. And 2 of those 3 are the reason Meta still prints $60 billion a year in profit. Now, many just assume that Mark Zuckerberg is some kind of founder genius, the Harvard kid who supposedly saw the future before anyone else. But look at his actual record and you'll notice something. Everything since Facebook that works at Meta was bought or copied. Meanwhile, the products Zuck came up with on his own have almost all ended up in landfill. And right now, he's spending up to $145 billion this year alone on, you guessed it, AI. So today, we break down how the buy it or clone it Meta monster works, what every product Zuckerberg built himself has cost his shareholders, and why the market has finally stopped funding the experiment. My name is Guy, and this is the Finance Bureau. Okay, before I rip into Zuckerberg, let's quickly play a bit of devil's advocate for a moment. In its 2025 financial year, Meta pulled in $200 billion of revenue and $60 billion of net income. In the second quarter of this year, revenue hit $60 billion, up 28% year-on-year, beating consensus. Daily users across Meta's apps reached 3.6 billion in June 2026, up 3%. Ad impressions grew 14% and the average price per ad grew 12%. There is no company on earth with a wider distribution footprint and no CEO who has held the top job for 22 years and kept compounding like this. On the numbers, Zuckerberg looks untouchable, a builder of the modern age. But run your eye down the asset list and ask a very simple question. Which of those assets did he actually build? Well, the answer starts with something the man wrote down himself. In emails later unsealed in the FTC's antitrust case, Zuckerberg's stated philosophy was that it's better to buy than to compete. On the 9th of April 2012, the day the Instagram deal was announced, Zuckerberg wrote to a colleague, quote, "I remember your internal post about how Instagram was our threat and not Google+. You were basically right. One thing about startups, though, is that you can often acquire them. And when it comes down to it, that's Zuckerberg's whole strategy. Instagram had 13 employees and 0 revenue. The headline price was $1 billion, though because Facebook's own stock fell after its May 2012 IPO, the deal actually closed at somewhere between $715 and $750 million. 2 years later, on the 19th of February 2014, the acquisition of WhatsApp was announced at $19 billion, and the deal closed in October at roughly $21.8 billion once the share price had moved. And Oculus, announced in March 2014, closed that July at $2 billion. Now, the interesting part isn't so much the shopping spree. What stands out here, once you dig into the detail, is how Zuckerberg knew what to buy. In October 2013, Facebook acquired an Israeli company called Onavo for a price most sources put at around $120 million. Onavo Protect was marketed to the public as a free VPN, a service that routes your internet traffic through somebody else's servers to preserve your privacy. The problem, though, was that the somebody else was none other than Facebook. Every app you opened, how long you used it, and how often you came back gave Facebook more data on what was working. Every bit of reporting has linked Onavo data to the WhatsApp decision because it showed WhatsApp message volume outrunning Facebook's own messenger. And when Snapchat's traffic turned out to be encrypted, an unsealed email dated 9th of June 2016 showed Zuckerberg asking his engineers to find a way to get, quote, reliable analytics on it anyway. What followed was allegedly an internal program to intercept and decrypt that traffic using root certificates. Now, Apple pulled Anavo from the App Store in August 2018 for harvesting data on other people's apps, and the product was wound down in mid-2019. Facebook then reportedly ran a rebranded version that paid users as young as 13 around $20 a month for near total access to their phone. In 2023, Australia's competition regulator fined two Meta subsidiaries $20 million Australian dollars over how Anavo was sold to the public. So, Zuckerberg used Anavo to spy on users and build a target list for acquisitions. But what happens when the target says no? Well, then you clone it. Snapchat refused to sell, so Facebook shipped Poke in December 2012, which briefly hit number 1 in the App Store and then evaporated. Then Slingshot in June 2014, discontinued by the end of 2015. But then, in August 2016, came Instagram Stories, a near feature-for-feature copy. It had 100 million daily users within 2 months and 250 million by mid-2017, which was more than Snapchat's entire user base at the time. TikTok got the same treatment. Lasso, launched in November 2018, was killed on the 10th of July 2020, and Reels arrived globally the following month. Twitter got taken on by Threads in July 2023, which gained 100 million sign-ups in 5 days and borrowed wholesale from Instagram's login system. Clubhouse got live audio rooms in 2021, rushed out and then quickly deprioritized. Be Real got a dual camera feature tested inside Instagram. So, the strategy has been buy it, clone it, or bury it. There is no fourth weapon in the Zuckerberg arsenal. But at least the clones sometimes work, which is more than you can say for the things he invented from scratch.
That's too bad. I don't know what happened.
Take Facebook Home in 2013. The company tried to turn Android phones into a Facebook-first experience, even launching it on a dedicated HTC phone through AT&T. It bombed so badly that AT&T slashed the phone from $99.99 to a mere 99 cents within weeks, and only around 15,000 were ever sold. Portal, the smart display nobody wanted to have in their kitchen, was killed off in 2022. Libra, the planned global cryptocurrency, was renamed Diem after central banks and legislators took it apart, with the technology finally sold off to Silvergate in early 2022. Novi, the wallet built for Libra, was piloted in October 2021 and shut down in September 2022. The Meta smartwatch, codenamed Milan, was cancelled around mid-2022 before a single consumer got to see it. And Free Basics was banned outright by India's telecom regulator in February 2016 on net neutrality grounds. So, 7 original products resulting in 7 spectacular write-offs. And then came the biggest bet of all. Reality Labs, Meta's division building its VR headsets, smart glasses, and Zuckerberg's broader metaverse vision. This venture lost $6.6 billion in 2020, then $10.2 billion in 2021, then $13.7 billion in 2022, $16.1 billion in 2023, $17.7 billion in 2024, and $19.2 billion in 2025. Add another $4.2 billion in the first quarter of this year and $4.6 billion in the second, against quarterly revenue of just $431 million, and that gets you to roughly $92.4 billion burned through. That's more than the entire market capitalization of most companies in the S&P 500. spent on a product that, in October 2022, prompted Vishal Shah, the Meta executive running Horizon Worlds, to write in a leaked internal memo, quote, "Why don't we love the product we've built so much that we use it all the time?" Around that time, Horizon Worlds had fallen from a peak of roughly 300,000 monthly users in February 2022 to under 200,000. Only 11% of users came back after week 1, and 91% of the world's people built never got more than 50 visits. Now, those are 2022 figures, to be clear, but Meta has never volunteered better ones since. And in March of this year, Meta announced it was shutting the VR version of Horizon Worlds down in June, then reversed the decision within 48 hours. Not exactly the confident stride of a company that knows where it's going. Now, keeping track of a spending cycle this large across earnings calls, court dockets, and leaked memos takes a ton of time, which is exactly why you should sign up for the Finance Bureau newsletter. It's completely free, and each week we break down all the macro developments and market narratives that are set to move your portfolio. So, just click the link in the description or scan this QR code to get started. Right, back to Zuckerberg. But before we continue ripping into the Meta man, let's offer a little bit of balance. To be fair, the strongest defense of Zuckerberg's buying strategy is that it was simply good capital allocation. He paid around $715 million for Instagram. That asset now has a standalone value of around $70 billion, and that is a low estimate. Meanwhile, it has around 3 billion monthly users and generates tens of billions of dollars annually, a significant chunk of Meta's overall advertising revenue. There is a reasonable argument that it's the single best acquisition in corporate history, and credit to Zuckerberg for having the vision to see the value in acquiring what was a relatively tiny startup at the time. And he knows how to play the legal game too. In November 2025, Judge James Boasberg ruled in Meta's favour and refused to unwind Instagram and WhatsApp, finding that the FTC had not proved current monopoly power, primarily because platforms like TikTok, YouTube, and Snapchat exist. The FTC filed its notice of appeal on the 20th of January 2026, so the fight isn't over yet. But as things stand, a federal court looked at the unwind theory and rejected it. And on another note, cloning isn't costless either. Reels and Threads required execution at a scale Snapchat and Twitter could never match, and distribution is a competitive asset. So, what does that defense actually change? Well, it changes the final verdict on Zuckerberg as a buyer, but it changes nothing about Zuckerberg the builder. Because the man who has never shipped an original product to success since Facebook itself is now running the most expensive original product bet in corporate history. In June 2025, Meta paid roughly $14.3 billion for a 49% non-voting stake in Scale AI, valuing it at about $29 billion. And what it really bought was one man, Alexander Wang, who left to run Meta Superintelligence Labs, reporting directly to Zuckerberg. Then came the pay packets, reportedly $100 to $200 million for individual researchers poached from OpenAI and Google DeepMind, and, in one reported case, a package notionally worth up to $1.5 billion over several years. So, we see the pattern once again. Can't build it, so buy the person who can. And so, what did roughly $14 billion and a talent grab actually deliver? Well, Llama 4 Behemoth, Meta's flagship AI model, hit severe training instabilities, slipped repeatedly through 2025, and was effectively shelved by mid-2026 without ever shipping. Yann LeCun, Zuckerberg's chief AI scientist and a Turing Award winner, walked out in November 2025 to found AMI Labs in Paris, which raised a $1 billion seed round in March at a $3.5 billion pre-money valuation. In a Financial Times interview in January, LeCun called Wang inexperienced, described the new hires as, quote, completely LLM-pilled and called the entire approach a dead end. Yikes. Then, Meta abandoned the open source promise with the closed-weight Muse Spark in April. And in July, in a leaked town hall audio, Zuckerberg conceded that the AI push, quote, hasn't really accelerated in the way that we expected, and that his executives had miscalculated the timeline. Meanwhile, the Meta rank and file paid for it. 600 were cut from the research unit in October 2025. Somewhere between 1,000 and 1,500 from Reality Labs in January this year. And in April, 8,000 people, about 10% of the workforce, were shown the door, with 6,000 open roles cancelled and a $1.18 billion severance charge booked in the second quarter. In July, 26 current and former employees sued in California, alleging Meta's internal AI tooling was used to rank people for termination, a claim Meta denies, stating that these decisions were made by people, not AI. And then there's the massive spending. Capital expenditure was $37.3 billion in 2024, just under $70 billion in 2025, and in April 2026 guidance was raised to a range of $125 to $145 billion, with the floor lifted again to $130 billion in July. That's roughly a doubling on a doubling in 2 years. In the second quarter of 2026 alone, Meta spent $31 billion of capex against $31.9 billion of operating cash flow, which means free cash flow came in at $784 million, down about 91% year-on-year from $8.5 billion. A company generating $60 billion of annual profit generated less than $1 billion of free cash in a quarter. After the April guidance raise, Meta's stock fell roughly 10% after hours, erasing close to $175 billion of value in a session, and the July results delivered a near identical percentage drop. As I record this, the stock now sits down about 25% from its high last August, down over 9% this year, all while the Nasdaq 100 is up about 17%. That divergence tells you it's not just us who's calling BS here. A huge chunk of the people who finance the mistakes we looked at today have stopped clapping, and they've stopped buying Zuckerberg's stock. 22 years of receipts show Mark Zuckerberg's genius was never one for invention. Instead, his skills lie in surveillance and a gargantuan checkbook used to execute an aggressive acquisition strategy that sometimes borders on illegality. That worked when the thing worth buying was a photo app with 13 employees. But it doesn't work when the thing worth buying is a research frontier that nobody has actually reached yet, because you can't acquire a product that hasn't been invented. Zuckerberg has been a prolific buyer, but now he may finally have run out of things to buy. The man who coined the phrase "move fast and break things" seems to be at a standstill. Well, that's about all we have time for today, but what do you think? Is Zuckerberg the greatest capital allocator of his generation, or simply the luckiest buyer in tech history? Let me know your thoughts in the comments down below. And if you want to understand the state of the AI build-out debt bubble, then you can check out our video on that right over here. As always, thank you so much for watching, and I'll see you in the next one. This is Guy, signing off.